Welcome to Countouts. In this lesson, we're going to be looking at absorption costing and marginal costing. We're going to be looking at the difference between the two and go through a thorough example which will help you understand the two costing methods very well. These are costing systems of assigning production costs to products. So that is what absorption costing and marginal costing do. They assign production costs to products, and we'll see where they differ. The key difference between the two costing systems is how fixed production costs are treated. If you can understand that aspect, you'll be able to know which one is absorption costing and which one is marginal costing, and you'll be able to calculate with whichever method you may be asked to do. So the key difference here is on how fixed production costs are accounted for. Here are some of the other differences. With absorption costing, the full production costs are allocated to products, and this includes absorbed fixed production overheads. So these are allocated to products. While with marginal costing, only the variable production costs are allocated to products. That is very key to understanding these two costing systems. The second thing is that inventory is valued at their full production costs. That's with absorption costing. And by full production costs, we mean both fixed and variable production costs. So with absorption costing, the inventory is valued at their full production costs with both fixed and variable. And with marginal costing, inventory is valued at variable production costs. And what happens to fixed production costs? They are written off in full as period costs. So that is another key thing with the two costing methods. With absorption costing, inventory will be valued at the full production cost, while with marginal costing, they will only be valued at variable production costs. And what we do with the fixed costs is that we expense them in full as period costs, and we'll see that just now with the help of an example. So if the opening and closing inventory levels differ, that is where production volumes are different from sales volumes. The profit reported for the accounting period under the two costing systems will therefore be different. I hope that has made sense. So you have opening balance and you have closing balance. If the two will be different, if for instance you had 50 for opening balance and for closing balance you have 100, that means they are both different. If the two are different, that means that the profit reported under the two costing systems will be different. So if you're using absorption costing and then you use marginal costing, you'll see that the profits will be different, and that is as a result of how the fixed production costs are treated. And you'll understand right now. So if you don't understand that statement, you'll understand very well as we go through this example that we're about to go into now. And then the last point here is if the opening and closing inventory levels are the same, this is where the production volumes are the same as sales volume, the profit reported for the accounting period under the two costing systems will therefore be the same. And for example, if the opening balance is 0 and the closing balance is 0, that means we have sold everything that we produced during that period. That means the profit for the two costing systems will be the same. So let's look at this example. But before we do, look at the format for absorption costing. The format for absorption costing will begin with sales, and then we have opening inventory at full costs. Remember, this is absorption costing at full costs, both variable and fixed production costs, and then full production costs that we used to produce during this period, and then we deduct the closing inventory at full costs as well. We deduct closing inventory at full costs. And then what we have with absorption costing is over or under absorbed overheads. What do this mean? Well, with absorption costing, what we will be given is the fixed production cost for the period, and we are also given the normal capacity for the period in units. So let me give you an example. If we are given the fixed production cost for the period of 50,000 Rand, and we are told that the normal production capacity in units is 10,000 units, that will mean that the fixed production cost per unit will be 50,000 Rand, which is the fixed production cost for the period, divided by the 10,000, which is the normal capacity, which will be given, which will give us a rate of 5 Rand for the fixed production cost per unit. Now, if you take that amount, 5 Rand, and multiply it by the actual production in units, so let's say you produced 12,000 units, for instance. If you take the 5 Rand and multiply that by the 12,000 units, we will get a fixed production cost of 60,000 rand, and that would mean that we have over absorbed, because it's over what we estimated or what we predetermined it to be. So if we have over absorbed our overheads, that will mean we'll deduct it when we are calculating our net profit. So if it's over absorption of overheads, we deduct it. That's why I put it in brackets here, over. But if you have under absorbed, so for that same example, if you produced 8,000 units only, we'll multiply 8,000 units times 5 rand per unit in terms of fixed production cost per unit, and then we get 40,000 rand. And remember, the fixed production cost is 50,000 rand. That means we would have under absorbed the overhead. So that means we'll have to add it here. We'll add the under absorption of overhead here. If that sounds a bit confusing, you'll understand it much better when we go through the example. But here's something to remember: if absorbed overheads at predetermined rate are less than actual overheads, then we have under absorbed and we need to add the difference. But if absorbed overheads at predetermined rates are greater than actual overheads, then we have over absorbed and we need to deduct the difference. So that is the key thing with over or under absorption of overheads, which we do when we are using the absorption costing method. So let's continue. So after we've done that, we will total this up, or we'll add them up, and then we get the total production cost of sales. Total production cost of sales, and we put that here, and obviously it's in brackets. And then we take the sales minus the total production cost of sales. We get the gross profit here, and then after the gross profit we have non-manufacturing costs, which we deduct, and after non-manufacturing cost we have our net profit. And that is the ultimate goal with this. We're trying to get the net profit using the method that you're asked to use. Now let's take a look at marginal costing, which would be far less difficult or challenging. So here we have sales, and we put the amount of sales there that we will have calculated. We have opening inventory. Now this is the key difference. Remember, the fixed production cost, which is the key difference between the two methods. With opening inventory, we have at variable costs. Remember, with absorption costing, it was at full cost, including fixed production cost. But with marginal costing, we have opening inventory only at variable cost. And then we have variable production cost, which will be what we produce during this period. We add that, and then we minus, or we deduct, the closing inventory at variable cost, and then what we have there is the variable production cost of sales. So you can see this one is much simpler than the absorption costing, but absorption costing is also easy, and we'll look at that right now using the example. So we take sales minus the variable production cost of sales, and we get contribution. So remember, the key difference between the two again is that with absorption costing we have gross profit, but with marginal costing we have what we call contribution. And then after contribution, now remember I said that with marginal costing we deduct the full fixed production costs for the period. So that is where we have the deduction here. After contribution, we deduct the fixed production costs, put it in brackets as a negative, and then we also deduct the non-manufacturing costs, which is in negative, and then we get our net profit. So we always arrive at our net profit regardless of which costing system we are using. So let's go to the example, which will make everything clear. In this example, we are told that ACM Limited produces a product that sells for 60 rand per unit. And we are also told that the variable production costs are 35 rand per unit, and the fixed production costs of 30,000 rand are absorbed on the basis of the normal capacity of 5,000 units per period. We're told that the fixed administration, selling and distribution overheads are 19,000 rand per period. There was no opening inventory for the latest period. What are we required to do? We are required to calculate the profit reported for sales of 5,000 units last period, for production volumes of 5,000 units, 6,000 units, and 7,000 units, using both the absorption costing and the marginal costing. So what are we required to do here? Here we are told that we sold 5,000 units, but now we have to do 3 examples. We sold 5,000 units when we only produced 5,000 units. In another example where we sold 5,000 units and we produced 6,000 units. In another one, we sold 5,000 units while we produced 7,000 units. So for all these units that we produced, we always sold 5,000 units. So now let's look at this example using the absorption costing. So I've drawn up the table over here. Now remember, this is the same table as we had before. The only thing I've done is that I've just done it in 3 different sets, because here we produced 5,000 units, here we produced 6,000 units, and here we produced 7,000 units. So now let's begin with our sales. What are our sales? Remember, we're told that we sold 5,000 units in the period, and how much is our selling price per unit? It's 60 Rand per unit. So we're going to take the 60 Rand per unit times the 5,000 units, and our sales figures are 300,000 Rand. So we'll put that 300,000 Rand under all of them, because remember, under all the 3 examples we sold 5,000 units. The only difference is how much we produced. So let's move on to the next one. Remember, we're told that we had no opening inventory during the latest period. So for all the 3 production volumes, we did not have any inventory in stock. But if we had opening inventory, remember, with absorption costing, we use the full production cost. That would be both variable and fixed production costs. So if we were to do that, we have to figure out what the full production cost per unit is. Well, first we are told that the variable production costs are 35 Rand per unit. And what is the fixed production cost per unit? Remember, with the predetermined rate, we take the fixed production costs for the period, which is 30,000 Rand, and we divide that by the normal capacity of 5,000 units. So we'll take 30,000 Rand, divide by 5,000 units. So that's what we'll do over there. And once we've done that, we see that we have 6 Rand per unit. That is the fixed production cost per unit. Now let's calculate the full production cost per unit. The full production cost per unit will be 35 Rand, which is the variable production costs, plus the 6 Rand, which is the fixed production cost per unit, and we get 41 Rand per unit. That is the full production cost per unit, including both the variable and fixed production cost per unit. So now that we have 41 Rand per unit, that will be our cost of production. So remember, for opening inventory, we put the dash on the 3 because we have no opening inventory. Now let's focus on the production of 5,000 units. What is the full production cost of producing 5,000 units? Well, we take the 41 Rand, which we just calculated, the full production cost, multiplied by the 5,000 units which we produced during this current period, and then we have 205,000 Rand, and we put that under the full production cost. And then we deduct any closing inventory. Well, did we have any closing inventory? Well, if you remember, we produced 5,000 units and we sold 5,000 units. Remember, like I mentioned before, and like we saw in the example, for all the 3, we only sold 5,000 units, or we sold 5,000 units. So whatever we produced in this example here, in this first example, is whatever we sold. So we don't have any closing inventory, so we put a dash over there. And then let's now look at the over or under absorption of overheads. So we have no over or under absorption of overheads. Like I mentioned before, if the opening inventory and the closing inventory are the same, remember from my points at the beginning, if they're the same, then we have no over or under absorption of overheads. Or in other words, if whatever we produce is exactly what we sold, like I said, we've produced 5,000 units and we sold 5,000 units, so there is no over or under absorption of overheads. The only time there would be over or under absorption of overheads is if the production volumes are different from the sales volumes. But in the first example, they are not different, so that's why we put a dash over there. And then the next thing that we do, obviously we'll add this together, and the only figure we have there is 205,000 Rand, so we'll put that under total production cost of sales. Remember, this is absorption costing. And then once we've done that, we take 300,000 Rand of sales minus the total production cost of sales of 205,000 Rand, gives us a gross profit of 95,000 Rand. And then what is the non-manufacturing cost? Well, let's go back to our example. We are told here that the fixed administration, selling and distribution overheads are 19,000 Rand for the period. So that is what we'll put over there, 19,000 Rand. And then we take the gross profit of 95,000 Rand minus the 19,000 Rand. We get a net profit of 76,000 Rand. And that is how we use absorption costing to calculate this first example. Now let's move on to the next one, where we produced 6,000 units. Remember, we sold 5,000 units in all the three, so that's why the sales stays the same. The 5,000 units which we sold multiplied by the 60 rand that we were given in the example, and then we had no opening inventory. And then now we ask ourselves, what is the full production cost? Now remember, here we produced 6,000 units. So what is the full production cost? We produced 6,000 units, and because this is the second one we're working on over here, and we're using the 41 rand per unit. So we take the 41 rand, which is the full production cost per unit, multiply the 6,000 units which we produced. So remember, this is produced, not sold. This is the full production cost that we're talking about here. We get a total of 246,000 rand. So we put that over there. Now let's go now to the closing inventory. What is the closing inventory? Now remember, we sold 5,000 units. So if we sold 5,000 units and we produced 6,000 units, we have a balance of 1,000 units. So we're going to take the full production cost per unit of 41 rand per unit, multiplied by the 1,000 units which are remaining in stock. We have 41,000 rand. So we put that under cost of a closing inventory. So we put it in negative because it's what's remaining. Now remember, like I mentioned before, which should make sense by now, if the opening inventory figure is different from the closing inventory figure, then we will have over or under absorption of overhead. Or if what we produced is different from what we sold, then we will have over or under absorption of overheads. And here that is the case. We have opening inventory of 0 and we have closing inventory of 41,000 rand, and we produced 6,000 units and we only sold 5,000 units. So we have over or under absorption. Now the question is, did we over absorb or did we under absorb? Well, let's look at that. First, here we are told that the fixed production costs are absorbed on the basis of normal capacity of 5,000 units per period. But remember, we produced 6,000 units. So what do? The absorbed overheads at predetermined rate, which is 30,000 rand, which is the fixed production cost, divided by the 5,000 units, which is the normal capacity, and we multiply that by 6,000 units which we produced during this period. We get a total of 36,000 rand. So we can see this fixed production cost here is more than the fixed production cost that we actually have for the period. So the actual overheads were 30,000 rand. That means we over absorbed. So if we over absorbed, we take the 36,000 rand which we estimated using the normal capacity, minus the 30,000 rand, which is the actual overheads that we incurred during this period, and we have over absorption of 6,000 rand. And that is how you calculate the over or under absorption. First, you calculate the fixed production cost per unit using the predetermined rates, which is using the normal capacity that you're given. So you take 30,000 rand, which is the fixed production cost for the period, divide by the normal capacity, which is 5,000 units, and you get the fixed production cost per unit, which is predetermined, and you multiply that by what you produced during this period. If the answer is more than the actual fixed production cost, then we have over absorption. If the answer is less than the actual fixed production cost for the period, then we have under absorbed. So in this case, we have over absorbed because the answer here is more. 36,000 rand is more than the actual overheads of 30,000 rand. So we have over absorbed, so we need to deduct it. So we have just deducted here over absorption. Since we over absorbed by 6,000, we deducted it here. And then what did we do? We took all these and added them up. We took 246,000 rand, which is the full production cost, minus the closing inventory of 41,000 rand, minus the over absorption of overheads. Remember, since it's over absorption, we deduct, and we have a total production cost of 199,000 rand. Now what do? We take the sales, 300,000 rand, minus the 199,000 rand, which gives us a gross profit of 101,000 rand. Now what you can see there, there's a difference between the gross profit between the two, even though we sold the same amount of units. And the reason for that is because some of the fixed production costs are lying in inventory, are tied to the closing inventory. So some fixed production costs will be tied to the inventory in closing inventory, because we divide the fixed production cost to each unit that we have. And then what are the non-manufacturing costs? Well, it will be the same, because in the example we're told that the non-manufacturing costs were 19,000, just like in the first one, and we have a net profit of 82,000 rand. From here you can already tell that the net profit is different, even though we only sold 5,000 units in both examples. The only difference between the two examples is that we produced more. We produced 1,000 more, which is 6,000 here. And you can see that the reason for that is because the fixed production costs are divided according to each unit, and whatever is sold, the fixed production cost will be incurred there. But then whatever is not sold, the fixed production cost for those units will be lying in inventory. So what you can see with absorption costing, one of the weaknesses is that the more you produce, the more net profit you'll have, or the more you produce, the more closing inventory will be, and that means that more fixed production costs will be lying in inventory. So now let's look at the production of 7,000 units. Since we've been going through this, we'll just run through it quickly. The sales are 300,000 rand. We have no opening inventory. And then what are the full production cost? Remember, it's 41 rand per unit, the full production cost, multiplied by the production of 7,000 units. Because we produced 7,000 units, we have 287,000 rand. So we put 287,000 rand as the full production cost. And then we deduct the closing inventory. Remember, we only sold 5,000 units, but we produced 7,000 units. That means our closing inventory is 2,000 units at full production cost. So we take 41 rand per unit full production cost times the 2,000 units left in stock, and we have 82,000 rand. So we put that in brackets, 82,000 rand. And then, did we over absorb or did we under absorb? Remember, we do the same exercise. Absorption of overheads at predetermined rate, we do the same thing. 30,000 rand, which is the fixed production cost for the period, divide by the 5,000 units, which is the normal capacity, and we multiply it by the units that we produced during this period. We have 42,000 rand. Did we over or under absorb? Well, I'm sure you can already tell by now. The fixed production costs are only 30,000 rand, and they absorbed overheads at predetermined rate are 42,000 rand. That means we over absorbed. So we're going to take the 42,000 rand minus 30,000 rand, which gives us an answer of 12,000 rand. That means we over absorbed by 12,000 rand, and if we over absorbed, we deduct it. So we put 12,000 rand in brackets over there, and then we add the 3. We take 287,000 rand minus 82,000 rand minus 12,000 rand, which will give us a total production cost of sales of 193,000 rand. Then we take the sales minus the total production cost of sales, gives us an answer of 107,000 rand. And again, what you can see is that the gross profits keep changing. And then what is the non-manufacturing cost? Non-manufacturing cost 19,000, which has not changed. And then what is the net profit? 107,000 rand minus 19,000 rand gives us a net profit of 88,000 rand. So if you are asked what is the weakness with the absorption costing, the weakness may be that the production manager may decide to produce so much inventory which will inflate their profits. And like I mentioned in the examples before, it's because the fixed production costs will always be tied to inventory. So if you have more inventory in stock or more closing inventory in stock, that means we have some fixed production costs lying with those inventory, and that means we are not deducting them during this period because they are lying in inventory and they will be in our balance sheet. And that is why you're able to inflate your profits by producing more. I hope you have understood absorption costing by now. Now let's look at the marginal costing. We'll run through this example because now you know what we are calculating and what we produced during each period. So this should be fairly simple. What are our sales? Remember, the sales will be the same for the two examples because we're using the same example over here. We sold 5,000 units and the selling price per unit is 60 rand. So 60 rand times 5,000 units gives us a total of 300,000 rand. So we sold for 300,000 rand for the 3 production units, and we have no opening inventory like we saw. It's the same example. And what are the variable production cost? Well, this should be simple. Remember, it's variable production cost and not total production cost. So we're only dealing with variable production cost, which is 35 rand over here, which we are given. So we take 35 rand, multiply by the 5,000 units which we produced in our first example. Remember, we're dealing with this one for now. 5,000 units. It gives us a variable production cost of 175,000 rand. So we have 175,000 rand over there. And did we have any closing inventory? No. For this first example, we didn't, because we produced 5,000 units and we sold 5,000 units. So no closing inventory. And here we have no over or under absorption of overheads. That is why marginal costing is much simpler to calculate. So we have no over or under absorption of overheads. And then we just add the 3. Well, we only have 175,000 rand. So we put that under variable production cost of sales. And if we take the sales minus variable production cost of sales, it gives us a contribution of 125,000 rand. Now remember, this is contribution with marginal costing. With absorption costing, it's gross profit. And then what are the fixed production costs? Well, we're given the fixed production cost over here. We're told that it's 30,000 rand for the period. And remember, with marginal costing, we expense the full fixed production cost for the period. It's not like the absorption costing where they are tied to each unit of inventory. So we have fixed production cost of 30,000 rand. And what are the non-manufacturing costs? Well, non-manufacturing costs are 19,000 rand, so we put that there. Then we take the contribution, 125,000 rand minus 30,000 rand minus 19,000 rand, gives us a net profit of 76,000 rand. So we've just done the one where we produced 5,000 units. Now let's look at the one where we produced 6,000 units. Remember, we still sold the same 5,000 units, so that's why we still have the 300,000 rand. We took 60 rand times the 5,000 units which we sold, and then we have no opening inventory. Now what is the variable production cost? Remember, we produced 6,000 units, so the variable production cost will be 35 rand. Remember, it's 35 rand per unit, a variable production cost. So we take 35 rand times 6,000 units which we produced, gives us a total of 210,000 rand. So that's what to put over there. And what is our closing inventory? Remember, we produced 6,000 units, we sold 5,000 units, so the remaining inventory in stock, or the closing inventory, is 1,000 units. So we take 1,000 units times 35 rand per unit, which is the variable production cost per unit, and we get 35,000 rand. So we deduct the closing inventory of 35,000 rand. So we take the variable production cost of 210,000 rand minus the 35,000 rand, gives us a total of 175,000 rand. So that is why we have 175,000 rand over there. And then we take the sales minus the variable production cost of sales, gives us a contribution of 125,000 rand. And you can see the contribution stays the same with marginal costing. And what is the fixed production cost? Well, it's the same as we saw before. And then what is the non-manufacturing cost? Well, it's still the same as we saw before as well. And what is the net profit? The net profit is still 76,000 rand, regardless of how many units we produced. Regardless of how many units you produce, the net profit will remain the same. And that's because you're expensing the full production cost, and the closing inventory is only with the variable cost. There is no fixed production cost tied to it. And then let's do the last one, where we produce 7,000 units. We have sales of 300,000 rand, no opening inventory. What is the variable production cost? Well, it's 35 rand per unit. So it's 35 rand times the 7,000 units we produced is 245,000 rand. And what is the closing inventory? Remember, we sold 5,000 units, but we produced 7,000 units. So 7,000 minus 5,000 units, we are left with 2,000 units in closing inventory. So 35 rand times 2,000 units gives us a balance of gives us the amount of 70,000 rand, which we put in brackets under closing inventory. And we take the 245,000 rand minus the 70,000 rand, gives us a variable production cost of sales of 175,000 rand. Again, we take the sales, 300,000 rand, minus the variable production cost of sales, and we get the contribution of 125,000 rand. And the fixed production cost is still the same, non-manufacturing cost still the same, and the net profit is 125,000 rand minus 30,000 rand minus 19,000 rand, gives us a net profit of 76,000 rand. Now let's quickly look at some arguments in favor of both absorption costing and marginal costing. So let's first look at absorption costing. Number one, fixed production costs are incurred in order to make a finished product. It is therefore fair to charge all finished products with a share of these costs. So these are arguments in favor of absorption costing. And the second argument is that the closing inventory values include a share of fixed production costs and therefore follow the requirements of the Internal Accounting Standards, or IAS, on inventory valuation. The third argument is that the costing model is in line with the accruals concept, as part of production costs are carried forward to be measured against future sales. And the fourth argument is that a problem arising from calculating contribution, which we do in marginal costing of various products made, is that it may not be clear whether the contribution earned by each product is enough to cover the fixed costs. Whereas by charging a fixed production cost to a product, as we do with absorption costing, it is possible to ascertain whether it is profitable or not. So these are some of the arguments that would be in favor of absorption costing. Now let's look at some arguments which would be in favor of marginal costing. The first one is that it is simple to operate. As we've seen with our example, it's easier to calculate the net profit using marginal costing than it is with absorption costing. The second one is that there are no apportionments, which are frequently done on an arbitrary basis of fixed costs. The third one is fixed costs will be the same regardless of the volume of production, because they are period costs. And we saw with our example, regardless of how much you produce, fixed costs will be the same because they will be expensed as period costs. And the fourth argument is that the cost to produce one more product is the variable production cost. Closing inventory can realistically be valued at this directly attributable cost, which is the variable production cost. And the fifth argument is there are no instances of over or under absorption of overheads like we have with absorption costing. And the sixth argument is that the best information for decision making is provided for by marginal costing. The best information for decision making is provided for by marginal costing. And the last argument that we have here is that fixed costs such as rent and depreciations and many other costs should be charged against the revenues of the period in which they are incurred. I hope that has made sense and that you now understand the difference between absorption costing and marginal costing, and you know how to calculate the two. If you have any questions or any queries, leave them in the comment section below. Otherwise, if you have gained value from this lesson, please consider subscribing to our channel and liking this video. Till next time, cheers.